Hey everybody, it is Wednesday, October 10, and this video is going to be about a couple of economic reports that came out last week. They come out monthly by the Institute for Supply Management. Uh, I like to look at them closely because they have a lot of really good information about what's going on across the broader economy. I think it's really good information that's well worth looking at, and I think the rest of you guys should also be aware of this information if you have any money invested anywhere. It's mainly intended for my thrift savings plan group members. However, this is a general economic analysis that I'm doing here. So if you invest outside of TSP, whether it be in an IRA or an individual stock account, whatever, there's still good information in here for you. So um, I meant to have this out last week, but I got home for several days and had more other priorities, obviously, and then some other things came up between technical issues with other attempts to record this or problem with my truck yesterday. So let's try this again. Hopefully, this take will be the one that I can actually stick on my page. Um, anyway, This is the this is going to be the September 2018 review for the ISM reports. The ISM reports come in two forms. They cover the manufacturing sector and the services sector. Basically, they break down all of the businesses and across the broader economy, and they break them down into these two different categories. And then between those categories, they break them down even further into 18 individual groups on each side. And each of those reports covers one group of 18 or the other. So this is what I'm going to cover here. I'm going to talk about the manufacturing sector first, and then I'll go over the services sector. I'll try to keep this a little bit to the point, but bear with me because there's always information on here that a lot of you guys have never seen before, or some of you guys are new to seeing this particular report. I don't know anything about it, so I do have to kind of regurgitate information I've already talked about in previous presentations of this. The reason why it's important is because economic data gives us a really good idea of what's going on across the broader economy. If we know what's going across the broader economy, we can have a better idea what to expect from corporate earnings or what kind of conditions companies across the entire economy, whether it's publicly traded large companies like we invest in with stocks, or private companies, or even government. So, but as far as stocks are concerned, like TSP, like the CS and I funds are concerned, our main interest in here is how do they impact the publicly traded companies or corporations, because the value of a corporation stock is based on primarily based on what its current earnings are and then what the expectations are for its future earnings. So this gives us a lot of good forward clues about what we might be able to expect from them as far as what conditions they actually are reporting from, if you will, from the horse's mouths. Um, I don't recommend making decisions to move your money around from one place to another without knowing having a much better idea of what's actually going on across the economy. You'll get a lot of bad information out there from the media and other quote unquote expert sources, whether the experts are actually professional investors or maybe people who seem to think they know what they're talking about. Well, this data is mainly my attempt to show you just how what the facts and what the fiction are. So with that in mind, let's move on to the manufacturing, or actually let's show you where I get this information from. Okay, these are the two web pages or the specific pages I got this month's specific data from. Just to give you an idea, also an easier way to work with. If you ever want to take a look at this page, the website yourself from the Institute for Supply Management, which I highly encourage you to do because there's a lot of good information in these reports that I don't cover here. And because as I mentioned, this was mainly suited for the TSP investor who only invests in stock index funds. If you invest in individual companies or even sectors or industries, there's still a lot of good information in these reports that I won't be talking about here that you can get a lot of good information from and might have a good influence on where you might want to focus your attention, or give you an idea if you should or shouldn't continue to hold something that you might have in your portfolio. So I'm going to go over there and show you their website real quick so you kind of have an idea how to locate this information yourself. So we're going to start here. Now, just ism.ws is all I put. ISM is the Institute for Supply Management. WS, I guess, is just website, whatever. This is just a shorthand thing. Then you're going to see that it's going to refer you or redirect to https www.instituteforsupplymanagement.org and then the index page. So, real simple to get there to the reports. Just go over here where it says News and Research, and then click on this ISM report on business. And right here are the reports. What I usually do is I click these view report links right here, and see, it shows you a lot of good information here. I'm just going to quickly go through this because I'm going to cover a lot more of this, in my own slides in a minute here. But just kind of give you an idea of what the information has. The other link here to the next to it, view charts, is actually a PDF version of the reports. It doesn't show, so actually it does this time. I have seen where it doesn't seem to show that. All right, just not paying enough attention to that. But these PDFs you can download and get some better info. Like, okay, a good example. Let's say new orders. 12 of 18 industries reported growth in new orders, which and that means demand, and they're in order. So, like textile mills here reported the strongest growth of new orders or strongest demand growth over the last month, and out of that, so then transportation equipment would have reported the slowest growth. So that's kind of how that works, and this is why this information can be useful for those of you who are not TSP investors. For those of you who are TSP investors, just keep watching, and I'll go over the rest of this information for you, and it'll hopefully make a little more sense to you what all this means. Okay, across the manufacturing sector, that I told you earlier, there are 18 industries in each of the two sectors. On the manufacturing sector, 15 of those 18 reported growth. The top three were textile mills, miscellaneous manufacturing, and plastics and rubber products. Only one industry reported contraction. That was primary metals. I'm not really sure I'd say that is any surprise, though, because as we know, primary metals, particularly steel, has been the most hard hit area with the tariffs. So that doesn't really surprise me at all. But what we really want to see here is how much participation across the broader economy are we seeing. The more companies or the more industries we see participating, the more fundamentally solid the reporting is. If we were to see maybe 13 reporting growth and then 10 or 11 reporting contraction, then it'd be overall growth, but I would expect slower growth or a little more shaky situation as far as the economy's health is concerned. So this is one of the reasons why I like to look at this information, because it helps me make more well-informed decisions about my own investments, and in return, I'd like you guys to have a better understanding of this so you're able to make more well-informed decisions with your own investments as well. what's been going on in the last week or so, or week plus, with stock index is a great example of that. But I'm going to cover that a little more later here. All right, let's move on here. The sentiment now from the manufacturing respondents, basically they boil down to these areas. They basically say that tariffs are affecting profitability and or long-term planning, cost planning. Part of that, one of the issues here is that the end of September, start of October is usually the turn of the new fiscal year for a large proportion of the companies in the economy that are across in the U.S. Whatever. Not every company has its fiscal year change on October 1st, which those of you who are TSP participants and obviously are government or military employees, you guys obviously know that October 1 is the start of the new fiscal year for the government. Uh, Private and publicly traded companies are both generally the same, but they don't have to be that way. And in fact, a good number of them don't actually end their fiscal years at this time. But having said that, now a lot of these companies are going to, obligate their funds or whatever, or set up their budgets for the next year or several years when at the end of a fiscal year. So, with the tariffs going on, uncertainty because of the tariffs. That's basically why that's being brought up. Is it's making it difficult for. It's more of a back and forth battle, I guess, between suppliers and manufacturers, like raw material suppliers and manufacturers or whatever. Uh, uh, what's actually an equitable deal for both sides, considering all this? So that's what that basically means. Moving on, though, business is still strong and stable according to the respondents, and that's always a good thing to see for a healthy economy. Lastly, job opportunities are available but are difficult to fill positions due to lack of interest or qualifications. These are my summarized words of basically what I read from those responses. They all have, there are several different responses you'll see. If you were looking closely at the webpage when I was showing you, you probably saw a good number of them there, but I scrolled through really fast. Um, Difficult to fill positions when we have unemployment rate below 4.0. This is no surprise to me at all. Again, this is something that we should expect. And the only way we can really do much about that problem of having job openings to fill, but nobody to fill them, is for more people to enter the job market than who leave. And that means uh, more births than deaths, or more people, just getting old enough or qualified enough to enter the job market versus, compared to how many are retiring or leaving the job market. Yeah. So, there's always an imbalance there, and that does tend to have impacts on employment rates. The other thing that can impact employment rates are immigration versus emigration. So, do we get more people migrating into the U.S., especially if they have qualifications that are useful to us, or to the U.S. economy, or U.S. consumers or end users, whatever the case may be? That actually helps the U.S. economy. Whereas when people who are capable of being in the, or are eligible job market, you know, people, when they emigrate to other countries, then they obviously don't help this situation here. So those are things that have to be watched out for, and that's where the politics really gets into play too, to some extent. And some of you guys will know that I'm a very strong advocate of not, the belief that politics don't really have as much of an influence on the economy as the greater masses believe that is the case. But regardless of that, what I'm here to report is what these reports here are specifically implying, as far as what the companies across the economy are actually saying. So let's move on now to the year-to-date data for the manufacturing sector. I have this up now because I want to show you just a little better idea of at least as far as the 12-month basis is concerned, or at least the year-to-date 2018 basis, what each of the different categories within this report, how they calculate compared to previous months with the same area. So also, I need to give you a little a caveat here that if you're looking at the actual reports on the ISM website, you're going to get different numbers than you see here. And the reason for that is because I basically subtract 50 from all of the actual results. And the only reason for that is because the charts that I show on the following slides, I want them to be presented in a way that is a little more visually easy to understand or figure out for those of you who are not so savvy about this or have never seen it before and want to get a better, at least visual idea of what this stuff means. So, with that out of the way, a lot of the stuff I'm going to cover is 3 and 6 month trends with the following charts. But as you'll see here, PMI, which is Purchasing Managers Index, which is basically the manufacturing sector overall figure, it was actually 59.8. You'll see plus 9.8 here for me, but it's really 59.8. What this means is that out of, let's say, 100 companies, if you were surveyed 100 companies or so, 59.8 of them, or 59.8% of the companies reported overall expansion, where they're actually growing. Doesn't necessarily mean profits, but it means they're expanding their infrastructure, perhaps. And the other 41.2% are reporting contraction, or maybe they're shrinking, in some way or another. So what we have here this month is it's a healthy number. These are, I mean, there have been some higher numbers this year, but don't let this number fool you, because 59.8, it's almost anything near 60% is a very strong, healthy economy. Um, Up until about a year or so ago, I think maybe it was 2 years ago. It's just been that long since I've been paying attention to this. There was, we had seen a 60 plus report, like say this 10.2 would have been 60.2. Yeah, when that was first reported a year or two ago, whatever, they were saying that was the highest number that had been seen in over 10 years, or even longer. So anything around 60, it's strongly positive. So this is just relatively speaking, though. It's kind of middle of the road, I guess, as far as this year so far is concerned. New orders, 61.8% reporting growth in new orders. That's a very strong number again. Anything above 60 is a good thing to see. It is a pretty good decline over compared to last month, 65.1. It's also the second lowest of the year. April was the lowest at 61.2, and in March was just above where we're at now at 61.9%. Again, we're kind of on the lower end of new orders growth, but that's still not a bad thing, because more new orders means more demand. More demand means more expansion coming. More expansion coming means there's pretty good likelihood that more companies are going to be reporting larger profits. So this is always a good thing to see here, and I'm going to cover those a little bit more in a bit. Production is a bit on the high side. I haven't seen anything higher than this month except for January, and I have an idea about this. I believe it could be seasonal as well as the end of fiscal year issue. Around this time of year is when a lot of the companies start to build a stockpile for Black Friday or other holiday shopping, or Christmas, or whatever holiday you might celebrate, if you do at all during that point in the year. Whatever the case is, this is a very busy time for the consumer. So, and because of that, the companies do tend to boost their production and employment to be ready for that. So, needless to say, the last couple months have been strong for both production and employment. Some of the stronger numbers across the whole year. I'm not going to go over those like I usually don't know, because they're a little more. They tend to be a little more volatile in nature and seasonal as well. So I'm going to move on here. Supplier deliveries is my interpretation of this is I believe this is what a representation of the transportation industry. How effectively are they keeping up with, or how much are they increasing their deliveries of loads? I think there's more to this than even I can even understand, because I don't have all the details. I don't know if this could if raw numbers of loads being delivered are concerned, or if they're going by freight miles, basically. Because it'd be one thing if you have a whole bunch of loads only doing maybe a 500-mile trip versus a whole bunch of loads doing a 2,000-mile trip. And the 500-mile trips can be delivered much more quickly and you know moved on to the next load a lot more quickly as well. But yeah, I'm not an expert on. I don't. I'm not a representative for the Institute for Supply Management. I don't represent any of the companies involved either, so I don't know what really that entails. But transportation industry is basically what I interpret it to mean. Kind of middle of the road here again. We had a weak month in January, but kind of, like I say, it's more of the same from what I'm seeing here, with the exception of June, which June was very strong. Moving on, inventories. It's also kind of middle of the road here. You see they're color coded by how strong they are. The more green they are, the stronger they are, and the more red they become, the weaker they are. It's been inventories have been adequate all year long, but yeah, and we're kind of right in that average area right now. Customer inventories, you see they're down. Basically, more companies are reporting insufficient inventories than are reporting sufficient inventories or too much inventory. This is this can be a good and bad thing. So it could be an issue of the lack of supplies could contribute to inflation, because as you all know, we have a supply versus demand driven economy. So whenever supplies go up and demand goes down, prices go down, and then if demand goes up and supply goes down, then prices go up. So when we see inventory levels dropping, then it's going to have it's going to have more of a influence for inflation to rise. So I'd like to see that change a little bit. Where maybe inventory is a little more adequate to make sure we don't have any issues with inflation in the future. Speaking of inflation, prices is another big factor in that. You see, this month was actually the weakest month reported over the entire year, which is a very positive sign. Uh, Positive number here is not a bad thing at all, because we do want to see some inflation. We just don't want to see it out of control. Um, However, and there are different ways to look at this one too. Are companies experiencing lower prices because maybe they have too much supply and now it's going to impact their reported earnings, because they purchased all this equipment or these items but haven't sold them yet, or they actually still moving the stuff and actually getting better earnings performance, which is going to drive more share price increases as well. We don't know that, but the main point here is that when prices are going up, then more likely a lot of companies' earnings are going to go up as well, which means share prices will also go up. So, and that still bodes well for those of you who invest in stock funds or any kind of stocks. A backlog of orders. The last 3 months have been a little on the weaker side across the year. You see the summer months, or actually late spring months, were strongest. Definitely weaker now. Whether that's being triggered by, or whether that's a result of transportation industry being able to keep up a little bit better, or something else, I don't know that, but you know, these are all question marks that I ask, questions I ask myself. That as an investor, I'm interested in knowing what's the real story here. You know, this just gives me more information to look for and do more research. Yeah. So anyway, moving on. New orders, new export orders. How much demand are we getting from foreign customers? And see, it's been kind of on the weak side over the last 5 months. I've been stronger earlier in the year. And when I first saw this report, the new export orders and the new imports both ticked up from last month. And when I first saw that, I thought, oh, that's a good sign for the I fund or the international stocks. For those of you who aren't TSP investors, the I fund follows the MSCI EAF index, where EAF stands for Europe, Australasia, and Far East. It does not include China, by the way, for those of you who might think it does. Uh, um, Looking at just from a month-to-month basis, that looked like a positive for the I fund, as well as maybe for the C fund, which is the one that follows the S&P 500. However, when you look at it from this perspective across the whole year, it doesn't really look so promising now, or at least not yet. It's still generally on the lower end. It's just now what's going to happen in the following months? Is it going to keep going up, or is it at least going to trend upward or something, or is it just kind of hanging around in a little bit lower area? So, I mean, these are still good numbers that should still favor stocks of any kind, domestic or international. However, like I said, it still doesn't really favor international stocks as strongly as it does domestics, as far as I'm concerned. Imports, you know, with both of these now, new export. The my logic here is that if in new export orders are increasing, then that means foreign economies are probably in better shape because they have more. Maybe their unemployment rates are dropping. Maybe they have more businesses there that require goods from us to do what they're doing, and when more of that's going on, they put more demand on us, and more demand on us is just a good thing for our economy as well. Imports, that's kind of the flip side of that, where when we're buying more from foreign sources, it's not necessarily as great for domestics. However, it does actually stimulate foreign economies, and when we can stimulate foreign economies, then they are probably going to be more stimulated into feeding back into us with new export orders from us. So those go hand in hand, and that's one of the reasons why I'm a big proponent of free trade agreements like NAFTA or Trans-Pacific Partnership and things like that. Funny thing is, I used to not be a fan of that, but when I learned a lot more about economics, I realized just how much I do like those. But anyway, this is let's try to keep this report from getting too long and out of control. So I'm gonna move on here. Okay, so the first two slides here you're going to see are basically a comparison of demand figures and the overall expansion or contraction that's being reported. So PMI, as I mentioned earlier, is the Purchasing Managers Index. I'm going to show you 3-month and 6-month figures just so you can see what's actually driving the overall number. And as you see, some of the orange bars here, some of new orders. Basically, in the last 3 months, new orders is outpacing the overall growth, which is always something I want to see. I can never get tired of looking at a chart like this where the new orders figures are stronger than the PMI, because more demand is just going to stimulate more expansion in the future, and that's going to keep our economy growing and corporate earnings growing and share prices going upward in the coming months when we can keep seeing this kind of stuff. As long as there are no bottlenecks that are uh, not allowing this demand to get met. But we'll get onto that as well. Now, some of backlog, speaking of, Basically, that tells how much has been ordered, but hasn't been filled yet. And there is a little bit of difference here, as you see. Now, where overall growth, the overall demand is growing at a faster pace than expansion. Backlog of orders is growing, but growing more slowly. Which my impression is that that's a very good thing to see, because we do want to see new orders grow, but we don't want it to grow too strongly, because if it grows too strongly, it's probably going to lead to a much more rapid increase in lead times, as far as how long does it take for um, manufacturers or producers, whatever, to get their raw materials from their suppliers, or how long is it going to take for end users to get what they want from the manufacturers and producers. So, but an increasing backlog of orders that at least is at least moving upward, but not as fast as overall expansion. Now I see that as good, because it shows that it's another sign of a healthy economy. Um, as long as the lead times stay the same and investors aren't getting apathetic, and that backlog declines because people canceling the orders because they can't get their needs met, or because the economy starts faltering, whatever. Uh, I'm okay here. It's let's say all this looks like a sign of a very healthy demand-driven economy so far, though. New export orders, you see here, 3-month trend has been lagging the overall demand and the overall expansion and contraction data. So that's another reason why I tend to favor domestic stocks over international at the moment, or at least as far as or in other words, for TSP investors, I favor the CNS funds over the I fund, as far as this kind of suggests to us. Now, looking at the 6-month trend, though, we want to see if there are any differences in that, because maybe these are slow. One of these is accelerating, or another one is slowing down, that can't be seen in another, just by this short time frame. So this is why I look at this information here. As you see, backlog of orders, that was a perfect example of that. Back in April, it was growing at a faster rate than the overall number, and it was still, overall up until last month, still at a faster pace in a 5-month period than the overall expansion or contraction reported. And then just this last month, it looks like either the overall growth picked up to a point where it outpaced it, or new orders slowed down enough to facilitate that. So yeah, that's a good sign, especially when we're still seeing that new orders over a 6-month trend is outpacing the overall figure. New export orders, you see, was actually slightly above the overall number in April, but has been lagging ever since. Again, this looks more favorable to CNS funds than the I. Now, it doesn't mean that I don't think the I fund's a good place to be at all. I think based on this and other, like the actual PMI data for the countries whose companies are involved in the I fund, I think those are good conditions still. But just looking at this report here only, the data suggests to me that domestics are better. Now, looking at supply now, as far as the manufacturing sector is concerned, well, we can see that supply or deliveries or the transportation, it seems to be picking up at a better pace than the overall expansion as well. That's also a good sign. Some of inventories, you see, it is growing, but growing slowly. I don't know if that's a good thing or a bad thing. I do want to see inventories growing. I just, whether if it's inventories growing fast or slowly, quickly or slowly, whatever, I think I'd rather see it at kind of a under control situation like we have here than growing too quickly. However, more rapidly growing inventories does also mean lower prices for some. But as I mentioned earlier, lower prices also means companies have probably purchased, businesses have probably purchased a lot of the supplies they need, but just haven't sold them, which does impact their earnings. So it's there is a give and take relationship here as far as companies are concerned when it comes to prices and supplies and all that stuff. Moving on though, customer inventories, you see it's been basically in decline, or at least companies reporting insufficient or less than ideal inventory levels. Uh, as long as they don't get too critically low, where that creates a more too much of a strong impact on inflation, or too much of an increase on lead times for previously ordered goods or whatever. Um, it's not really a big. I don't see it as being a problem. So we'll see. We'll probably see the new orders figure um, probably decline more, or some more volatility and just demand in general. If there does start to become too many issues with downstream supplies. Moving on, let's look at the 6 month between and compare it to this one. Looks pretty much the same to me. It's supplier deliveries is still stronger, all the way across the whole 6 month trend. Upstream inventories, they also look like they're growing slowly. Actually, it looks like it's been it was mostly flat in the April to June period, but it looks like it's picked up a little bit, so that's a good sign. And if we move back, then it's just more of the same for the customer inventories. I think that's enough for supplies. Let's move on to prices. See here, more companies are reporting price growth than are reporting expansion. The more companies that are reporting price growth, the more likely it is that we're going to see higher inflation. Doesn't mean that we necessarily will, because we could have, let's just say, 80% of the companies reporting price growth, but maybe the price growth is more moderate or mild in nature, whereas we could have maybe 60% reporting price growth that is much more strong or profound, whatever. Yeah, those paint two different pictures of inflation, possibly. So, what I mean here is that this information is insufficient for predicting inflation as a whole, but it does give us an idea how likely it is that we're going to see inflation in the future. So, at the moment, this does look like a very good sign for inflation. Just as long as we don't get hyperinflation and a more aggressive Fed with interest rate policy, then there's nothing wrong with this. All right, 6 month trend is just nothing different there, so nothing really else to really cover here. Now that covers the what I really want to talk about with the manufacturing sector. So now let's move on to the second half of this, which is the services sector. I also mentioned earlier that there are 18 industries within this sector, and within this side, 17 of them reported growth or expansion. The top three industries on this side are mining, real estate, rental and leasing, and wholesale trade. Now, in the group, Scotty Cox did say something earlier about an observation he had about how real estate seemed to be performing unusually well in these rising interest rate conditions, which, as you mentioned, yeah, it is unusual. Normally, real estate companies or real estate investment trusts, the ones who have properties that they lease out to businesses or individuals, whatever, they tend to report better profits in a lowering interest rate economy and not one that's growing. There's more to it than that, though. There are certain areas within the REITs that might benefit more in a rising rate environment versus others. But I'm not going to go into detail about REITs because focus of this is the ISM reports anyway. However, I will say when I get to the conclusion part of this presentation, I will give you kind of an impression what I have about the real estate industry in general, because there is certain information that you're going to see on the next slide that kind of ties in with it, and I'll go over that more later. But as far as the services sector was concerned, though, none of the industries reported contraction. There was really only one that could have possibly reported contraction since it didn't report growth. However, it didn't even report contraction. That industry basically reported stable, like sideways moving conditions. In other words, so very strong positive breath from both sectors, which is a very positive sign for the broader economy as well as for stocks. Let's move on to this. I'm going to give you some of the sentiments on this. Now, on the services sector, I did cherry pick this information a little bit more because I couldn't. Yeah, there are more responses and not necessarily a clear trend as far as like multiple responses given like the same kind of answer, like tariffs, whatever. So that's gonna let if you look at the actual reports, you're gonna see a little bit more consistency between what I have here and what was written there. Now, have that with that in mind. The first response said logistics costs rising due to increased governmental regulation and shortage of Class A drivers. Now, we've seen this Class A driver shortage issue brought up quite a few times over the last several months. So, what that means is supply issues, and that's where the rising costs are coming from because, well, I mean, of course, demand also growing is going to factor into costs, but uh, the upstream suppliers, just because there's so much demand, but only so much supply or ability to get it moved. That's what's having that impact on it. Now, I believe that response in particular was given by a accommodations and restaurant type of company. They don't specify exactly which company it was. Just tell which industry the response came from. But that's just one of. I mean, it's kind of a general sentiment, regardless. Though another response was residential construction market is strong, but labor shortages and tariffs are being treated as earnings headwinds for construction companies. This is one of the things I talked about in the previous slide that I'm going to cover with the real estate market later on. Um, so obviously, because construction industry for building structures, especially businesses, they tend to need steel or aluminum. Yeah, so these tariffs are having an impact on them. But trying to keep these things moving, though. The other responses are economy continues to show strength, which I always want to see. Business activity above normal, supported by end of fiscal year purchase requests. Again, business activity above normal is always a good thing to see. But end of fiscal year purchase requests, that's good and bad. That's a good sign that we're seeing some seasonal strong behavior. However, what happens after the fiscal year when people have finished buying all what they need to buy or what contracts they need to sign for the next year or whatever it is? That's where the question marks come. Lastly, tariffs causing prices to rise that are difficult to pass along to end user due to competition. Low finished goods inventories inflating home prices and causing buyers to delay purchases. Okay, again, that's another area I want to cover a little later on in the conclusion with the real estate market. For those of you who might be interested in what my thoughts on that are. Um, as you know, the 2008 recession was largely a result of real estate. So, yeah, and I'm sure that is going to concern some of you guys. So I'm going to share some of my thoughts on that later. All right, overall, the year-to-date figures for the services sector. We see a lot of green this month, and which is a strong, which is a good thing to see. However, the brunt of the strength seems to be coming from business activities and employment, which is probably a seasonal thing due to end of fiscal year and holiday, whatever you want to call it, shopping, uh, behaviors or preps. So, personally, new orders, it's growing at a very healthy rate, but it's not as strong as it was earlier at the beginning of the year. So I mean, and it's roughly the same growth rate as the NMI, or which is, for those of you who wonder what NMI means, that means non-manufacturing index, or services is another name for it. Uh, I usually like to see the new orders, or demand, especially, figures driving this overall number more than anything else. But what we really have is business activities and employment, which is more seasonal, and then prices, which are, yeah, I'd also rather see something else than that. But overall, everything looks pretty healthy. Um, Even inventories, both upstream and downstream inventories, they're in pretty good shape here. It's kind of middle of the road here. More little on the stronger side for price growth. Only May had a stronger number as far as what percentage of the sector reported price growth. Backlog of orders generally on the stronger side over the last 5 months. There was one weak month in July. Might have been a seasonal thing, or it could have been a transitive issue there, but you know, generally strong numbers from backlogs. New export orders, those are also strong, generally strong over all year long. Again, these are, remember, add 50 to all of these numbers to know what the real number is, as far as percentage of the sector reporting that. And again, 60, more than 60% growth in an area is usually always going to be considered a good thing. Imports, yeah, this is an area where we saw some growth, and that was actually the strongest number we've seen all year from the services sector as far as imports are concerned. I don't know if tariffs are a factor in this, and then there are also questions about, well, what countries are these imports coming from? Because what we really want to know is, as far as thrift savings fund investors, is, are these imports, or how much of these imports are coming from companies that are part of the I-Fund. And some of this tariff activity and workaround stuff that's been going on doesn't necessarily have anything to do with the companies that are in the I-Fund. So, yeah, we can go into more deep analysis on that, but I'm not going to. Uh, Plus, I want to keep this moving on now. Inventory sentiment, which is basically the downstream inventories, still growing. It's been a very healthy year overall. Generally been on the weaker side the last 4 months, but it looks pretty good. So, moving on to the demand figures for the services sector. You see the overall number in the orange bars is also outpacing the overall figure, which again is what we like to see. That means it's probably a demand-driven economy. Backlog of orders, you see it's been trending upward, but more slowly than the overall as well, which, as I mentioned earlier, something I like to see. And new export orders, those have actually outpaced new orders over the last 3 months, so that's a good sign. Uh, this does have give a better picture for the I-Fund or international companies than the manufacturing sector did. But I got something else to mention on that too in the conclusion. So I'll just move on that, and just services sector alone, though, it does look a little bit more favorable to I-Fund, if anything. All right, looking at the 6 month trend, however, and it's even more to support the I-Fund, possibly here. The orange bars, of course, new orders. It's been outpacing all year long, or at least over the last 6 months. Backlog is, you see, it looked like it kind of flattened out over here in the June to July area, but picked back up, and it's still looking healthy. New export orders, it actually has been outpacing, from April all the way up until now. Whether it looks kind of like stable, to me. Maybe you guys have a different opinion. It does look like it's kind of a steady, slightly outpacing kind of climb there, from what I can tell, though. And more in particular, how does it compare to the overall new orders? Now, in April, Export order demand growth outpaced overall demand, but since May it's been behind. Looks like it's kind of been holding about steady pace there. So, um, good arguments can be made for any of the stock funds in TSP. Though, to be honest with you, as far as the 6 month figure is concerned. So, but move on though. Let's talk about supply. 3 month figure here. We've got the supplier deliveries. Transportation industry obviously is not growing as quickly on the services end of the economy as it is on manufacturing. It's not keeping up with overall expansion, which is probably going to create some supply issues somewhere down the road, unless they beef it up from maybe like play the uh, steal from Peter to pay Paul kind of situation. Unless the transportation industry can pick up the pace more with more drivers getting hired and more equipment to have them make their deliveries with. 6 month figure here, the supplier deliveries actually 6 month trend actually looks pretty good. It's actually outpaced the overall figure of the last 6 months. I had the same thing here for 3 months. Now it's compared to the inventories, which it's slower here, but growing. Also generally slower here, but still growing. So that's there's nothing wrong with that. And the inventory sentiment is it's kind of close. Uh, this month maybe it slowed down a little bit, but it's still growing. But over the 6 month trend, it's still outpacing overall. Um, the inventory sentiment or the when the supply levels are adequate or growing, whatever. Again, this is going to be a good factor to help um, prevent inflation from going out of control. And since we have a strong demand-based economy, then these increasing supply levels are not a result of um, companies purchasing or whatever too many supplies and now not having anyone to sell them to. So all in all, it still looks good. Prices, same situation here as was with the manufacturing sector. We've got more companies reporting price growth than are reporting overall growth. 3 month and 6 month, they look the same. So again, this is a positive for inflation, probably a positive for overall corporate earnings, and probably a positive for share price uh, or stock price behavior over the coming months. Uh, that pretty much concludes all the charts. So I'm going to talk about uh, what my overall impression is, what I like and whatnot. At the moment, basically all this information suggests to me that the conditions still they tend to favor the S fund or small cap domestic companies over everybody else. As you know, for a lot of you in my group know, I am still 100% invested in the S fund myself, and I intend to stay there. However, good arguments can still be made for both the C and I funds, or if you remember, the C fund follows the S&P 500. A word about the S fund, by the way. A lot of people mistakenly believe that the S fund follows the Dow Jones Industrial Average. No, it does not follow the Dow Jones Industrial Average. The Dow Jones Industrial Average is a large cap exclusive index with 30 companies that are also in the S&P 500. So it's really a redundant index, and we don't have a fund that specifically tracks the Dow Jones Industrial Average. In fact, you can go on pretty much any retirement plan or mutual fund or other investment site, and it'd be hard pressed to find funds that specifically track the Dow Jones Industrial Average, while virtually everybody has something that tracks the S&P 500. Now, where the confusion comes in is with the S fund, it follows an index called the Dow Jones U.S. Total Completion Index. The Dow Jones name in there is where everyone gets confused. Dow Jones is just the name of a company. It's not the name of an index. It's the name of a company that runs a whole bunch of different stock indexes. Um, yeah, so Dow Jones Industrial Average, the one that you guys mistakenly believe is the S fund, is just one of numerous indexes they manage. The U.S. Total Completion Index has over 4,000 companies in it, and they have all market cap sizes, from large down to micro. But it exclusively, I mean, it specifically excludes the 500 companies that are in the S&P 500. So because it excludes the S&P 500, it also excludes the Dow Jones Industrial Average components. So the more I can get people aware of this and understanding this, the better it is. Because we always get questions in our group about, well, how come the S fund went down when the Dow Jones was up today? Well, there's your answer. That's not the right index to follow as far as the S fund is concerned. Now, uh, right, now moving on with this. Okay, iFund. It's been down for the year. I have no idea why, because this all these ISM reports that I do look at every month haven't been giving me that impression by any stretch of the imagination. Also, I do frequently look at the PMI data, or the manufacturing data for all of the countries that have companies in the iFund. And the information that I've been seeing in those don't give me any indication of why the iFund should even be down. It should be up. Um, Maybe not up nearly as strongly as the CNS funds or U.S. stocks have been this year. However, it should be up from what I can tell. Whether it's just fears of uh, or pessimism that isn't necessarily warranted, or maybe a result of the U.S. dollar index, where the dollar's value relative to those same countries' currencies may have gone up too much, which I don't think was really the case. I've tried researching that on the dollar index chart, and I don't get that real impression from it. Yeah, it did have a bit of a strong area for a bit, but I mean, kind of went sideways from what I could see. So I don't have a real good answer for why iFund is down, or EFA, which is the ETF the iFund invests partially in, or the EAFE index, if you will. For that matter, I think the iFund should be up, and I do think there theoretically should be um, some good gains, shorter term gains that you might be able to get from those international stocks. But then we have other issues like the IMF just, I think yesterday it said something about warning about a slowdown in global growth. So that could be playing into some of the issues with the iFund. I don't really know. I don't have a good way to track all the companies in the iFund because there are about 1,000 of them. They also tend to only report earnings every 6 months instead of every 3 months, like we do here in the U.S. And also, I don't have access to that full list of 1,000 companies like I do the S&P 500. So that in mind, I have a lot less information to work with on the iFund, which means I'm definitely less capable of giving a really good, solid answer on why one fund, why the iFund or the S fund, for that matter, might do one thing that the C fund doesn't. So anyway, I still think that conditions still favor stocks in general. Doesn't matter where you're invested, domestic, large cap or small cap. International should be able to get something out of it, although, like I said, I do favor the domestics and particularly the small caps myself. Um, I'm still 100% in the S fund or small caps, and I intend to stay there. Which reminds me, I'm sure a lot of you guys have been worrying about what's been going on with the stock markets over the last week. We've been seeing several 1% drops in a single day. And today, I think it was, I'm not looking at the chart right now, but I was seeing more than 1.5, even almost 2% drop in some of them today. What this is called is panic selling. Worst thing you can do is be a panic seller, okay? If you don't know what's really going on with the economy or corporate earnings, you probably shouldn't be making any moves with your money. And a lot of you guys are suffering from this addiction to watching your account balance always move upward. And you get these worries about what happened in 2008. Okay, 2008 had much different economic conditions to work with. This same report here I gave you here had a much different set of numbers that it was presenting. And there were quite a few other reports that were giving warning signs as well. We're not seeing any of those warning signs right now. Also, we have another quarter of very strong earnings growth expected this quarter between October and December. By my figures, as you might have seen from the video I put out last week of the end of quarter figures, I believe it was just about 25% year-over-year growth I'm expecting across the S&P 500 this quarter. And I believe small caps are expecting stronger, more than 30%. So that's another reason why I like the S5. It will taper off some, but I still expect to see share price growth even above the more recent highs. So I don't think that the drops that have been happening recently are anything to be concerned with. Speaking of this drop, I've been following along with that, and I've been finding out that a lot of this drop recently, over the last week, has been triggered by concerns over bond yields. Okay, bond yields are still up barely in a 3.25 range, or somewhere in that neighborhood for the 10-year and longer bonds. This is nothing to be concerned about to me. And if you think that the economy is going to hinge on what bond rates are over the course of a single week, you might want to reconsider your thought process, because I'm going to tell you, you're going to be completely wrong if you think a single week worth of changes to bond yields is going to really have an impact on the long-term performance of stocks. Now, when bond yields do go up and stock earnings yields do go down, it will make bonds more attractive to investors than, or more, at least in terms of ratios are concerned. But stocks are still a better place to be, in my opinion. Something else I was going to mention here on this part. It doesn't really get to the point till, or maybe bond yields get higher, like considerably higher, normally up above 5, even 6%, is when we normally begin to see the stock prices top out and the start of a bear market begin. So we're nowhere near that point right now. When we have lower in general bond yields to work with, that means that stocks are going to probably be more attractive for a longer period of time before the tide shifts toward bonds. Because here's the difference between a professional investor and an average retail investor. A professional investor is not going to move their money from stocks to bonds just because they see their account balance dropping. They know that they're going to have drops here and there, but they're looking more long term. Also, speaking of that, they want to, as far as over a certain time frame, whatever their horizon is. It could be 1 year, it could be 5 years, whatever the case may be. They're more interested in what's actually going to give them a better overall and safer return on their investment than the other. So they'll start moving their money to bonds when they just think that bonds are going to get them a better return on their investment, or more gains on their investment than stocks will. So in other words, if you have, let's just say, bond rates get up to, say, 6%, but stock earnings yields are only at like 3%, and stocks are more inherently, well, they call them risky. I don't really call it risky. I call it volatile. But when you have a comparison of something that is generally less volatile and has twice as much of a expected return rate than one that is a lot more volatile, is where would you put your money? You'd probably be more interested in the bonds, because you can get a 6% return on your investment instead of a 3%, and have a much better degree of safety to go with it. This is the mind of a professional investor. The mind of a retail investor who makes tons of mistakes is, I'm going to log into my account. I'm going to take a look at my balance is. Oh my God, I lost a couple $1,000s today. Oh my God! Over this last week, I've lost $10,000 or $40,000 just in a week or two or whatever. And seeing those dollar signs disappear makes them panic, and they get these visions of 2008. I got news for you. 2008 was the third worst bear market in stock market U.S. stock market history. So the odds of us having a recession like that I don't think, are not so great. The average bear market is nowhere near that deep or as long as the 2008 recession or bear market was. There is a distinction between a recession and a bear market, by the way. Um, Recession is 2 quarters of negative GDP growth, whereas a bear market is stock prices drop 20% or more and stay down for at least 2 months. So there's a difference between what actually drives stock prices and what actually what indicates a recession. So I want to make sure you guys also are um, informed about how that works. If you want more details on that, or look at my video I posted last week of the end of quarter or the end of third quarter review. But you know, so overall, that's all I have. I will end this with the explanation of the real estate musings. Whatever the things that I brought up earlier. I have a feeling that the reason why there's less demand on the residential real estate market may actually be because um, retail, basically consumers or home buyers, whatever, are getting more hip to um, just how much more effective it is to have a cheaper house to buy, but that one that they can more easily afford to buy, and have more discretionary income available on the side that they can spend on other things. Whereas prior to the 2008 recession, what happened was is all these prices were getting inflated. Everyone was buying up all these homes, but they were paying too much. They were doing all these subprime mortgages and adjustable rate mortgages and finding themselves in a position where they didn't have discretionary income to spend. Well, guess what? When you don't have discretionary income to spend, you don't have durable goods to buy for your homes. You don't have cruises or vacations that you're able to afford to do. You aren't able to go out to eat at restaurants or whatever. Well, what are all those things that you're doing with that discretionary income? You're patronizing businesses. You're giving them income. You're supporting their earnings. So if you don't have discretionary income to spend, then you don't have. Then those companies that rely on the discretionary income are not going to make as much either. And when you see a lot more of the discretionary expense companies losing out, you're going to see more unemployment increases, more people losing jobs, and then what people do have jobs and do have discretionary income might start pinching a little bit more and be unwilling to spend it because they're worried about what's going to happen with the economy now. We don't have that going on right now. We have, as you saw, a very healthy, strong economy. So I get the impression that you know that home buyers have actually learned some really good lessons from the 2008 recession and just know better than to spend more than they really need to be spending for their homes anymore. And in turn, I think that has a lot to do with why our economy or our current economic expansion is lasting as long as it is. Because it allows that discretionary income to spread across other parts of the economy for a longer duration of time and get more people involved in the economy. So that's where I think that's coming into play. Now, as far as the REITs are concerned, my answer to Scotty on this, I'm not a total expert on REITs by any stretch, but just an impression I'm getting based on what I have kind of researched or whatever figured out. Um, I think because of the fact that maybe residential buyers are less willing to spend as much for their homes means they're more willing to rent. Um, so when they're more willing to rent, it puts more demand on you know, on those REITs who have the properties that are available for rent, whether it's multifamily dwellings or it could even be businesses. Maybe they don't want to spend on their own properties, so they'll just lease from a REIT instead. So I think because of that, I think it's actually having a positive impact on REITs more so than expected. And as you might have seen over the last, yeah, it's quite a few quarters actually, I've been talking about how I've been expecting the REITs industry, REIT sector in general, to have declining earnings, which should be translating to declining share prices as well. However, share prices have, I haven't looked real closely at that, but I have seen signs of where it has gone up, and I know earnings have definitely outperformed what I expected them to do over at least the last few quarters. So that's been a positive influence on REIT share prices as well. So I hope that answers the question pretty well of what I think that might be going on. Um, and overall, I think this is I see a lot of really good positive stuff here for the economy in general. I say I'm not going to worry about what's going on with recent share price drops. I think it's all much ado about nothing. Um, Also, speaking of that, with the panic sellers, it's not just retail investors who have a tendency to panic sell. Those of you who invest your money in IRAs or mutual funds or ETFs or whatever, or some kind of plan where it's an actively managed fund, for example, you have more of a likelihood for those hedge fund managers or the managers of those funds to want to produce results. And they're also, unfortunately, they're also enslaved to your guys' demands too. So when too many of you guys who are investing in their funds are saying, we want you to get rid of this particular stock because of this or that, whatever, they're more apt to cave to your guys' demands, even though they might know more than you do. But they're worried about you taking your money to someone else because they're not willing to meet your needs. So they have a much different game to play there, and it's you know they have they get put in a tug of war a lot more because of that than someone like myself who is only posting this because I myself am personally invested in TSP. I don't have a single dime invested in what you guys have. It's or whether it's TSP, regular stocks or whatever. I'm going to invest in what I want, and why for my reasons. I have no vested interest at all in where you have your money invested, but obviously, hey, if I'm willing to put my own money up in a certain area, then and I know as much as I know about economics and stocks, then pretty good chance those of you who aren't so well versed in stocks, you know, hopefully I'll be more willing to accept that. Hey, if I say this is going to go up or move back up in the near future, it's probably going to go up. Please do not succumb to that um, addiction to watching your account balance grow and then start freaking out when you see it dropping for reasons you can't figure out. Okay, because like I say that I've seen way too many very costly mistakes made by doing exactly that. I don't want you guys to make that mistake. All right, so please stay in your stock positions if you're already in them. Do not be selling out to the cash or G fund or whatever you want to call it, depending on where your investment is. Because at this point, stock prices have already dropped at least a good 4 or 5%, even more I think for the S fund or small caps recently. And if you move out now, you're locking in basically you're securing a loss. And then if the market turns around and rebounds in the near future while you're still sitting there, guess what happens? You just sold at a lower price and you're going to buy back in at a higher price, which is going to cause you to lose on both ends of that. That's for that reason I can't tell you enough how strongly I mean this, that you should uh, not allow emotional investing or panic selling, or basically, which is what panic selling is, to fuel your decisions. If you can't explain something or don't have a good answer for something, best thing to do is don't do anything at all. You might hear someone's opinion on something, but it's better if you hear one person's opinion. It doesn't matter how experienced or professional they are or not. Do as much research as you can on what they're talking about. Um, how reliable is the information they're working with, or how quickly does the stock market really react to whatever they might be pointing out? And this is a good example for those of you who might see that stocks are overvalued because of what they call the Shiller ratio, or the cyclically adjusted price to earnings ratio, which is also known as CAPE. That's more of a long-term 10-year type of ratio that compares price performance versus earnings performance. That makes these weird adjustments. Tell you what, the stock market doesn't really react to at all to overbought conditions on that. It sometimes takes quite a while for the stock market to make that into self-fulfilling prophecy. So that's one of the reasons why I don't personally pay even the least bit of attention to that CAPE ratio. Um, Interesting data to work with, or just kind of a interesting indicator, but it doesn't mean everything. It's just one of those tools in the toolbox, and it's not until we start seeing a whole bunch of things going on is when we should really be concerned about the health of our economy. This information here hopefully gave you a really good idea that it looks like anything but an unstable and economy that's on the verge of falling. So, all right, that's all I have for now. I hope you enjoyed all this. I know this was a little bit long-winded, but the main point is I hope you got a lot of really good information from it, and I hope it helps you make more wise and objective decisions with your investments. Thanks. That's all I have. Bye.